Stop looking at the screen. Look at the number that matters. $61. That is the physical price of silver right now. It is a mathematical bomb. The $61 spot price has severed all ties to the fantasy world of futures trading. The paper price sits at $29. This is not volatility. This is a deliberate terminal system failure. The gap is over 100%. This spread is the sound of trust imploding. The system is screaming for metal. Cannot deliver the paper promises. This systemic logic has been coded into history for over a century. Every time this rupture appears, a major financial structure is about to collapse. The powerful made an unlimited promise. Now, the limited physical asset is calling their bluff. The $61 number is your flashing red light. It proves that the entire paper pricing mechanism is a lie. You are watching history accelerate. The recursion is active. Prepare yourself. You need to understand the historical violence that always follows this signal. This is the final warning before the squeeze goes parabolic. The current divergence is a direct echo. It shows a leveraged system being exposed. This systemic logic always starts with a concentrated failure of trust. We saw it clearly in 1890. The pressure point was the gold standard. The core logic was identical. Washington tried to use politics to solve a math problem. The Sherman Silver Purchase Act of 1890 was the political fix. It forced the Treasury to buy 4.5 million ounces of silver every month. This was an attempt to inflate the money supply. But the market is never fooled by dilution. Gold reserves began to bleed out of the Treasury vaults. Confidence was the real asset draining away. By early 1893, the Treasury's gold reserves had dropped below $100 million. That threshold was critical. It was the point of no return. The public instantly recognized the dilution. They understood the leverage on the system. The inevitable collapse followed immediately. The panic of 1893 was not chance. It was the predictable outcome of overpromising a physical asset. Paper guarantees proved worthless. Bank runs exploded. The systemic failure was proven. The 1960s presented the exact same pressure on silver specifically. For decades, the government suppressed the metal's price. Silver was vital for coinage and industry. It held dual utility. The price was capped artificially. This is how managed markets operate. The official price was held far below its real economic value. In 1964, the U.S. took silver out of its dimes and quarters. This was a critical admission of failure. The government literally could not afford its own money anymore. Physical demand immediately surged from the public. People were melting down the old coins. They grasped the intrinsic value instantly. The system could not sustain the price facade. The lie was exposed. By 1967, the U.S. Treasury was officially forced to stop selling silver. They ended all sales at the pegged price of $1.29 per ounce. This single forced action caused an immediate price jump. The physical world flatly rejected the paper control. This is the simple, systemic logic of scarcity. Physical reality always asserts itself over political decree. The peak moment of this squeeze pattern came during the inflation of the 1970s. Fiat money was rapidly losing meaning. Prominent families saw the inevitable endgame. They started accumulating physical silver. They simultaneously took control of the futures market. Their strategy was cold logic. They demanded delivery. They wanted the metal, not the promise. This demand for the physical asset is the critical mechanism of exposure. By the end of 1979, the COMEX exchanges reacted. They imposed harsh new rules to stop the accumulation. This was a political act of desperation. They knew the fractional reserve paper system was failing. They had to protect the structure. In January 1980, silver rocketed to its peak, nearly $50 per ounce. The market briefly found its true physical price. Centralized control was overwhelmed. Then came Silver Thursday in March 1980. The exchanges changed the rules completely. They drastically increased margin requirements overnight. This was financial violence. It was a deliberate move against the physical buyers. It was done to protect the heavily leveraged paper system. The market is not free when the rules can be changed by the biggest players. The consequence of this intervention was immediate. Silver futures crashed 50% in 4 days. The manipulation was naked. It remains a historical marker of centralized power overriding free market price discovery. The pattern is clear and unforgiving. Physical demand exposes a leveraged paper system. The system defends itself by changing the rules to avoid delivery. The stress is not solved. It is simply deferred until the next, more violent cycle. Now, consider the modern leverage. The amount of paper silver traded today is astronomical. For every ounce of real, physical silver available, conservative estimates suggest over 200 ounces of paper claims exist in the derivative markets. This 200-to-1 ratio is a guaranteed formula for terminal catastrophe. It shows a paper leverage that relies entirely on one assumption. The assumption is that no one will ever actually demand delivery. The futures market is a gigantic, upside-down pyramid of promises. It sits on a tiny physical base. That base is cracking right now. The price disparity we see today, $61 spot versus $29 futures, is the initial undeniable failure. The physical buyer is paying a 100% plus premium. They are paying to secure the actual metal. They are not buying a paper contract. They are buying insurance against systemic failure. The market is signaling a critical, immediate shortage. This is not just metal scarcity. This is a shortage of trust. This is the moment the recurring mechanism of paper failure accelerates into its final destructive phase. The historical framework is the clear blueprint. We must apply the cold logic of the pattern to the current moment. The current systemic logic is more subtle. It is a digital extraction of physical reality. Today's $61 spot price is not an accident. It is the real-time cost of bypassing the congestion. It is the cost of going around the controlled derivative exchanges. The mechanism used to manage this modern divergence is sophisticated, but its core function is the same as the gold bleed of 1893. It is the control of liquidity. It is the desperate avoidance of physical delivery. Look closely at the COMEX inventory levels right now. The pool of eligible silver is shrinking fast. This is the metal that can be delivered against futures contracts. The systemic stress is becoming dangerously visible. Based on the latest reports, the total COMEX registered silver inventory stands at under 35 million ounces. This is an absurdly small physical amount. It is supposed to back hundreds of millions of ounces of open interest contracts. This is not resilience. This is ultimate systemic fragility. The fraction is mathematically untenable. This is the final evidence. The paper system is a collapse waiting to happen. The modern control mechanism relies on this inventory figure to prevent a sudden panic. As it shrinks, the risk accelerates faster than you can imagine. The backdrop is the banking system's terrifying exposure. Global debt-to-GDP ratio has gone beyond all previous historical limits. International Monetary Fund data shows global debt now exceeds 300% of global GDP. This is the oxygen that feeds the silver squeeze. The financial system cannot afford a single major default. It absolutely cannot afford a systemic run on physical assets. The leverage is everywhere. From sovereign bonds to housing, the modern control mechanism is subtle. They do not need to openly declare a margin hike. They can simply allow the paper futures price to be suppressed. They absorb the derivative losses. They allow the physical price to run free in the shadows. This decoupling is the classic sign of internal system decay. They are sacrificing the derivatives market. They do this to maintain the illusion of stability in the wider, more leveraged financial system. The futures price is being held down by massive, concentrated short positions. These are paper promises to deliver metal that the sellers do not physically possess. The spot price, $61, is the real price. It is set by those who reject the paper promise entirely. They demand the physical truth. They see the pattern repeating. The official inflation numbers are another deliberate deception. The Bureau of Labor Statistics CPI dramatically understates the real cost of living for everyone. Using honest, historical calculation methods, real inflation is far higher than the reported 3% or 4% figures. This true erosion of purchasing power is forcing a flight into hard assets. Capital is abandoning the paper currency. It seeks refuge in metal. This is the cold logic of self-preservation. When the currency itself becomes a risk, the price of the alternative becomes parabolic and impossible to ignore. The current fragility is not just leverage. It is complexity. The sheer number of derivative contracts built on top of other derivative contracts guarantees failure. A single failure point, like a silver squeeze, will cascade throughout the entire system. It is a guaranteed systemic chain reaction. The $61 spot price is the hammer blow that starts the fall of the first domino. The historical pattern has always ended in a violent revaluation. It is a reckoning where paper promises are violently, completely retired. This time has no exit. The mechanism is now fully engaged. The $61 spot price is the final, clear warning. The core prediction is not a number. The core prediction is that the systemic logic will complete its cycle. When the registered inventory is finally exhausted, the market will realize. The $29 futures price is a mathematical impossibility. The paper system will break instantly. This moment will not be a slow bleed. It will be an instantaneous, catastrophic implosion of the derivative markets. The remaining short sellers cannot deliver the physical metal. They will face a margin call that cannot be met by anyone. The counterparties will fail immediately. The consequences will be felt globally. The realization that a major commodity market has simply stopped functioning will shatter confidence across every leveraged asset. The price of silver will not just rise. It will reprice. It will move in a non-linear, unpredictable way. It will reflect the true cost of systemic insurance against the final fiat collapse. The price will reach triple digits. This is not hope. It is the absolute mathematical necessity driven by the hundreds to one leverage ratio. The contagion cannot be contained. When the physical market dictates the price, the illusion of centralized control over everything will vanish. Banks holding massive paper assets will face catastrophic write-downs. The credit markets, which sustain the modern economy, will instantly seize up. This is the critical moment. This is the collapse of a debt-based system. This has been encoded into the global system for decades. The political promise of endless paper liquidity has finally run into the mathematical consequence of physical scarcity. No rule change, no regulatory intervention can stop this run now. The divergence is too extreme. The pattern is too robust. This video explains historical and economic systems. It is informational, not financial advice or price forecasting. The time for hesitation is past. The $61 spot price has delivered the verdict. The paper structure is failing the physical test. You have seen the systemic logic in 1893. You saw it in 1967. You saw it in 1980. You are watching the final act play out right now. The promise made by the central authority is political. The consequence is purely mathematical. This is the immutable law of history. The promise is political. The consequence is mathematical. No one escapes. Do not let this critical analysis be lost to the shifting algorithms. Subscribe now to ensure you receive the next stage of the systemic logic as it unfolds. Join our membership for deeper, unvarnished breakdowns of the inevitable financial collapse.